Yeah, so we'll just start off with
Here
your
we go.
background. How did you get into this stuff? And then go into how to make money from bankruptcies.
How
Uh,
to make money, the secret sauce.
this is
I'm
the
gonna
most
give you the secret.
important thing.
I'm gonna give you the secret sauce tonight. Um, well, thanks for chatting. So, you know, I grew up kind of I don't know, a lower middle class sounds kind of weird, but sort of middle class, lower middle class, just sort of regular kid in Savannah, Georgia, where I'm from in the States. And my parents were lawyers. My mom was a bankruptcy lawyer in particular, not a big corporate, bankruptcy uh, attorney, but a consumer bankruptcy attorney. So I grew up learning a lot about the bankruptcy code, just kind of that way, and that kind of led on to it's sort of a repeating theme in my life. I suppose that's true for everybody. You grow up in, like, I don't know, your father or your mom works in some industry, and it sort of comes back around or informs you later. So for myself, I grew up that way and sort of hanging out around bankruptcy courts and growing up sitting around law offices, waiting for my parents, or hanging around the courthouse with attorneys. And I was sort of, for myself as a young kid, I was very interested in Warren Buffett and people like this. I would say Warren Buffett. I mean, were there other people as a kid? Probably not. It was just like Warren Buffett, Ben Graham. These are sort of what everybody, I guess, or a lot of people, for a lot of people, was are inspirations. And for myself, not too different. So I was very, very interested in, principally in business, I think. And then when I learned who Warren Buffett was and who investors were and things like that, I was like, wow, I want to do this. When I allocate capital, whatever that means. When you're 15 years old and you have no money to allocate, and you're going to allocate it, all $15 of it. And so I sort of I tried to emulate them and took a job in New York after I graduated from undergraduate, and worked in consulting for a few years. But I was sort of still unhappy because I really wanted to be involved in like principal investing, and whether that was like working in a hedge fund or working in anything. I just wanted to be involved with like invest in capital. I don't know why. It's just something that I always found interesting. And I don't know, sort of fast forward, I worked in consulting. I was getting kind of sick of it, so I went back to grad school. I did a master's in quantitative finance, which is super interesting and quite informative. But I don't use it in my day-to-day work. But it's like anything, sort of it informs the way you think about the world. And I'm gonna close my door because someone opened my door here, and you can probably hear my kids in the other room. But hold on a second. But I'll still talk. So did that for 2 years, did my master's. And then when I got out, I was like, okay, well, I can go work at a firm that I don't want to work at, or I can go and start my own firm and just kind of do it my own way. And that's kind of what I went with. I figured, if Warren Buffett did it at 26, I can do it at 26, and launch my own hedge fund. It was quite a learning experience. You're way, way too young to launch a fund or run capital when you're that age, other than your own. But I did it anyway. And, some people, a few investors came along for the ride with me, and I dearly appreciate them. I think the problem with being that young when you launch is you don't know a lot about the world. You haven't seen a lot of different industries. You haven't gotten, I don't know what the technical term would be, but sort of whacked by, a big drawdown and things like that, which will eventually happen to just about everybody. And so, yeah, I did that. Launched that fund 2012, did that till 2018. So it wasn't an insignificant amount of time. It's a long time. And eventually my business partner and I sort of like really grew apart and sort of decided like he didn't really want to work on the small fund. And, and I wanted to keep going. So he wanted to close the fund and I wanted to keep going. And we said, all right, well, we'll liquidate the fund and, we'll just go our separate ways. I started working for some family office clients that I'd met while managing the fund, and then some new ones that I'd met. And, long story short, I sort of took on this sort of weird boutique distressed investment advisory business. So for the most part, we're sourcing distressed opportunities direct, and the family office CIO will have sort of direct say, whether it's a claim or a debtor in possession loan or buying a business, and we'll tee it up. Sometimes we're putting capital in, a lot of times we're putting capital in just from accumulated savings, and we're trying to find interesting opportunities. So that's kind of how I got started, and I kind of pulled us forward to today. But go ahead, I'll be quiet for a second.
Normally when you hear of bankruptcy, you wouldn't assume it to be a good place to make money, right?
That was always a good one. You hear that.
So how do you make money out of a bankruptcy? Do you target bankrupt companies or post bankruptcies? Let's get into the technicals.
Yeah, sure. So you can be a total window shopper and play large bankruptcies where you're not doing anything other than trading securities. I'm buying these bonds. I see the restructuring plan. I'm going to get bonds back, and I'm going to get equity in this new business, like a Hertz or something. And I like that. I like Hertz. I like the brand. I like the valuation. I can read all the bankruptcy filings. This is American bankruptcy. And I'm just going to be a passive participant. And that's fine. And you can get more active where you say things like, well, I don't like this valuation. I'm going to object to the current bankruptcy. I've got money. I'm going to try to put money into the company and restructure it. And then you get even more active where you're saying like, well, I'm not going to buy any security. I'm going to be the stalking horse, meaning that I'm going to be the lead bidder to buy the assets out of the bankruptcy, or I'm going to be a debtor in possession lender. And I'm going to try to really get myself deep into the weeds of this company and try to, if things work out well, I'll get paid my interest and go home. If things don't work out well, I'm going to be an active owner of this business, and I have an operating team I'm going to bring in. So you can really run the whole gamut. I think and I got this from Asworth de Modern's book, who's a sort of a famous valuation professor at NYU. But I'm sure other people have said this, but there's a whole like crisis. What is it? Opportunity is no. Or I can't remember what the phrase was, but something about crisis meaning opportunity. And there's sort of this nice thing about that's kind of what distressed investing is. And so for the most part, some people think that you're buying dying companies and you're buying them very cheaply. That is extremely far from the truth. If it was easy to buy dying companies and just take a few puffs of them, some guys try to do that strategy and it's okay. Some people can make a little bit of money on it, but you really won't make sort of big dollars doing that. You're better off finding either resetting a company, meaning like changing its footprint. So for instance, if you took a retail chain that's quite profitable in certain regions, but not profitable in others, or maybe you're going to switch it from being retail to online, but the brand still has a lot of equity and people still like the brand. Or you're going to reset just their whole asset portfolio. So think of a gym chain, a fitness gym. It might be very profitable in certain regions, certain locations might be very profitable, at certain locations might be horrible. And so through the bankruptcy process, you can shed a number of leases and just focus on your most profitable core. Why would someone allow that? Because on one level, you think, well, that's not fair to the creditors, because the creditors, they're going to need to pick and choose which claims they pay and which assets they keep. But on another level, if you actually look at the recoveries, what you're doing is you're saying, well, we're going to optimize the business, ongoing value of the business to be its most profitable, like sort of economic unit. And then we're going to allow someone to either restructure that or buy that out of the bankruptcy, free and clear of liabilities. And what that allows is it actually allows for better recoveries for all the constituencies, not just the creditors, but the entire sort of stakeholders, right? So like, how do you save jobs in a bankruptcy? Well, you try your best to restructure the business around a profitable core. Without a profitable core business, there's no business. I mean, it's not a charity. So unless it's going to be something where the government finds some strategic reason, or either a government or some sort of nonprofit finds a strategic reason, it doesn't work. It's not sustainable unless there's like some profit in the structure that you've made. And so if you look, actually, there's all this empirical research on returns within different insolvency regimes around the world, everywhere, you know, you name it. Middle East, you can go all the way to Asia, you can come back around to the States. The progressive bankruptcy system in the United States allows for the best recoveries to all stakeholders, including creditors, and is like by far a huge landslide. And so you see a lot of regimes around the world adopting these practices. But the opportunity is getting involved in messy restructurings where you might be able to add value, whether it's a refinery that's run into environmental problems, or it's a gym chain that's overexpanded and had too much debt on it, too many leases that they can't afford, and they need to reset to their profitable core. Or, you know, Hertz, I can't describe Hertz. I mean, it's, you know, when there are some certain things that are incredibly exogenous and you can't possibly anticipate. And, you know, those companies, when they go through restructuring, whether it's, you know, Diamond Offshore was an offshore drilling company, these huge, like $200 million, like floating oil rigs. I mean, these things, when oil is at $20, they don't make a whole lot of economic sense when you have a lot of debt on the structure, on the capital structure. So the opportunity is around. I mean, you sort of, you know, for instance, I remember there was one Westinghouse, and in this bankruptcy, and that'd be fun to walk through something like full all the way through the case. But in that one, they had a nuclear services company that ministered, or I should say run, sort of about 50% of all the nuclear reactors around the world. That sounds valuable, right? It's like a monopoly. And then they also were construction plants for third parties. Well, they had some cost overruns at the plants they were building, and all of a sudden they ended up in Chapter 11 in bankruptcy. And so the opportunity for somebody was, for ourselves, we were buying claims against the plants, and we were buying creditor claims into bankruptcy. But even someone like a Brookfield Asset Management, which is like a well-known asset manager, they showed up and bought the nuclear services business, which is basically a monopoly. And they paid, I want to say, $4 billion for it. This is all rough numbers. They put about $1 billion of equity, $3 billion of debt. Now that business is worth $10 to $15 billion. And why is it? Because at the time, people were like, oh, this was like 2016, 17, maybe 18. People were like, oh, nuclear is on the way out. No one likes nuclear. And now, you know, you watch the headlines. It's like, oh, well, we need nuclear if we're going to get off oil. It's like, okay, well, now you love us. You know, 5 minutes ago, you hated us. So there's opportunity, and it's value investing, but it's sort of extreme value investing. So that's how you find opportunity. At the end of the day, you're just trying to find inexpensive things, contrarian ideas, you know, but it's wrapped in a blanket of distress. But buying dying companies is definitely not the strategy, which is what some people think it is. And it's a pet peeve of mine. I always push back on this idea.
Well, that's interesting. So from a retail standpoint, can a retail investor buy up those claims?
I mean, I would say that claim buying for the retail investor, well, they technically can. Technically, you know, you don't like need to be any sort of like SEC requirements. I would say if you want to do it with spend a lot of, I suppose like a lot of things in life. If you want to spend a lot of time on it, and you have and you have the will, the conviction, you really want to spend time doing this, you can definitely get into the industry. I would say that you're probably better off if you don't want to spend like all of your time doing this. You have a day job, you know, you're a doctor, you're a lawyer, you know, podcast, whatever you do, you have other activities. You might want to consider just playing the more public bankruptcies, the larger ones where you can buy a security, whether that's stock or bonds. And, you know, you sort of follow the restructuring and you read the news about what's going on. And you think, hey, I think car rentals are going to come back. Like Hertz is a great example. The stock was under $1. You know, the stock was under $1. Now, did it help that, you know, the way things played out in the bankruptcy? For sure. But you could have followed what was going on in the bankruptcy. And then there was a bidding war for the business. And the stock was at probably $2 when there was a bidding war, and the stock went off. I mean, I think at the end, now you'd have to do the split adjusted, but in the bankruptcy, you probably could have ridden it from like, you know, $2 to $8 or something like that. And the same thing's true with a few other bankruptcies. So you can follow the news and invest in some of the stuff. I wouldn't say do it with all your money, but this is true of most things in life. Even if you think venture capital is interesting, I don't know if you should put all your money in venture capital. And I would say distress is probably similar. But if you just want to sort of do it through your brokerage account, you need to just follow the big ones. And they're probably a few times a year, or maybe once a year, you're following a case or two. But you can wait. Part of Buffett's whole, there's no called strikes. If you're running a fund, the fundamental advantage you have is you have a lot of information. You probably spend all day looking at it, right? The advantage you have as an individual is you don't have to swing at everything. You can wait. You can wait a whole year. You can wait 3 years. You can wait 5 years. And you're probably better off doing that as an individual, and you'll have better returns because of it as you sort of wait. And so use your advantages to your own advantage. If we were playing tennis or playing any sort of sport, the whole thing is like, okay, well, this guy has a terrible backhand, so I'm just going to keep hitting into his backhand. It's like, that would do a similar thing. You want to sort of think about that, like, well, these guys have to transact all the time. I don't have to do anything because I'm already wealthy, or I already have a day job, and you should be using that to your advantage. And that one idea will really set you free and improve your results, I think.
From a public bankruptcy, would you rather take the equity or the bonds? Do you have a preference, or is it different from each bankruptcy case?
It really is different. It really is different. It really is different. I would say for the most part, buying, I would say one of the things that people do make a little bit of a mistake on when they're on the far end of the risk spectrum is they do buy lottery tickets thinking that it's going to work out. So they'll buy things, 10 cents, 20 cents, who knows what could happen. It's like, yeah, who knows, man. And all I'm really thinking is like, you basically just, might as well go to the casino, probably have more fun at the casino. So there's some of that you got to be careful of. You can't just punt around with the money unless you're gonna read and keep up with what's going on. You're better off to stay out of that stuff. The other side to it is if you go further up in the capital structure, whether it's preferred shares or you start playing around in bonds, if you have access to bonds and things like that, yeah, that's probably a better place to be. I think you just need to have a healthy respect for the prices in front of you. And then there's nothing wrong with having a variant view, but you gotta have a real reason to have it. And you better have done a little bit of work. It's not a free lunch. So
what I would think is the bonds would probably be the better risk-adjusted way to play it. Or, you can just buy it cents on the dollar and just wait and get a better price. Or is that not how it works generally?
So I met a guy the other day on like Saturday. We were chatting on the phone, and he was saying, we really have a barbell approach. So I can normally buy a lot of the bonds and I buy a little bit of the equity and I sort of play both sides of it. I think that's a very sensible approach. I think that's a very, very sensible approach. So for the most part, you probably want like 80% of your money, who knows, 90%, that's not investment advice. You want a good portion of your capital in something more safe. And then it's like, okay, maybe there's a bidding war. I'm getting tea leaves. Someone just filed a motion to have an equity committee. So I'm going to buy, I'm going to take some of my bond. I'm going to take it off and I'm going to buy some equity. But that's really if you're playing, sort of this game of, you're just renting it. You're not really involved in the process. You're sort of passively following what's going on. You're reading the news and you're reading maybe the docket. And these are like American style bankruptcies. European and anything like if you play in the Middle East or in Asia, those are much more complicated to play. You really, really need to know the legal process to be able to transact in them for a retail investor. But there's lots of opportunity.
So how do you find opportunities? What resources do you use, or do you generally get deals?
get deals. Man, I'm waiting for someone to just knock on my door and be like, hey, I got all these great deals for you, Tom. Normally those are deals you don't want. But we still take them. I still take the phone calls. I still take the calls from people that inbound with deal flow. It's a combination, like in any business, I suppose. If you're doing business development, maybe you're following all the dockets, all the companies that file for large Chapter 11, like in the Wall Street Journal or the Financial Times. So that's one area of sourcing. Another area of sourcing might be, having Google alerts around companies that might be restructuring or considering restructuring. And then a third one might be your network. You're spending a large amount of time building your network. I mean, I think in distressed, and I don't know about other areas. So I always love to meet people and like they're very good at what they do, but in a totally different area than me. Like, I don't know, like a top chef or someone that's like really good at a different type of investment strategy. I always love meeting them. So I always love to compare notes about like how they source and how they think about risk and things like that. And so I'm like fascinated with, whatever documentaries about like a top chef or something like that. I just find it fascinating. It's like the whole other side is your network is so valuable. And, being someone that people want to transact with. In venture capital, guys have this idea that it's a double opt-in problem. I don't know if you're familiar with this idea. They say it's a double opt-in problem, meaning like the founder has to want to choose you and you have to want to choose them, right? Because like, of course you want to invest, but the founder doesn't like you because you were such a jerk, when you were going through the process. And there's something to be said for that in distress as well. I mean, I'm not sure all the distress guys appreciate that, but if you did one deal with this guy, or when I say this guy, it'll be like a restructuring professional or an attorney or a CRO, and he hates you because you were such a pain to work with. Guess what? He is not calling you again. I mean, so there's something to be said for this sort of double opt-in problem where, of course, you want a good deal and you want to like, sort of get all the things you want in your documents. If you like a deal, but you want to make sure it's sort of buttoned up. But there's also something to be said for leaving something on the table when you're doing deals where people might be repeat customers. And there's a phrase to this. Someone said this. I mean, there are a few people that have said things like this, but you should always leave a little something on the table. And I think it's true in stress because you want to be able to get those repeat calls. So again, you're sort of following the dockets, following all the stress news. And then, of course, you have, screens and things like that. And then the third is you have a strong network. And that takes years. Only now in like 10 plus years of doing this, have I got a bit of a network where people will call. And it's not every day, but, a few times a month, you might get an inbound. And of those 3 to 10 inbounds you'll get in a month, one will be something you can do. And so it's a combination.
So from an outsider coming into this industry,
Oof.
It's not easy.
Tough, man. It's not easy. It can be done. I would say that what do some people say about learning something? It's like sometimes the feedback loop is so long that it's like you don't even know if you're getting better. And I think part of the problem with distressed is there's like some people in distress, it's very similar to like merger arbitrage. Like first rule merger arbitrage, you don't teach anybody how to do merger arbitrage. And I think that's true in distress somewhat, where you get a lot of guys who will say things like that. They'll be like, look, don't be teaching kids how to do this. Like, there's only so much to go around and you don't need to be teaching people how to do this. And it's a real thing. People really get like upset at you. But for myself, I didn't come from distress. My parents, like I said, I had a little bit of a different background, which is my parents were bankruptcy lawyers. I knew a decent amount about bankruptcy. And so I started doing claims before I started doing distress, like bankruptcy trade claims. And I sort of said like, well, no one wants to do this. I didn't even have like a real prime broker. Like when you are trying to buy distressed bonds, you have to have real prime brokers. And that means like you have to have quote unquote lines, like distressed lines with like Morgan Stanley, like Deutsche Bank or whatnot.
So how did you manage that?
Yeah, so it's I'm not trying to. There's I did distress claims because I knew enough about it to be dangerous, and no one wanted to do it. Like I was like, oh, distress is like a great area. I should do more distress. And I had this one case that worked out very, very early. And I used that to the money and the story to raise a little money to launch my fund in 2012. And I sort of said, I know a lot about this. I should do more claims. And I started doing more claims. And the first contracts I wrote myself, which are horrendous, and no one should ever write their own contracts. Just call me and I will help you out. I promise I'll just hook you up with a lawyer who will help you for like $1,000. But like, do not write your own contracts. I use my own contracts.
You used to write your own contracts.
I wrote my own contracts. The first deals I did, I wrote my own contracts. Don't ever do that. It's a bad idea. And luckily no issues with the seller and no issues with the claims. But I wrote my own contracts. And I mean, I say I wrote my own. I basically lifted what I could find off the internet and sort of like, oh, I'll change this a little bit. I'll change that a little bit. And, sort of made a pastiche of a contract. And, but I did it because no one wanted to do it. And I could get into it even with my tiny, minuscule amount of capital. When I launched my hedge fund, I had $400,000, which sounds like a lot of money, but for an investment management firm is nothing. Because you're only making basically 2 and 20 on the 400. So as you can imagine, it's like, maybe you could buy, no, you can't, you can hardly pay for the lights. So I started doing that because no one wanted to do it. And over time, I got better and better at it. And I realized like, oh, I know a lot about the bankruptcy code, and most of the distress guys, they know a lot about like big bankruptcy stuff. They know a lot about the high yield market, but they don't know anything about the bankruptcy code. I mean, these guys are like oafs when it comes to the bankruptcy code. And they would say things that are so like if you knew about the bankruptcy code, you would think like, well, that's not true. I don't know who told you that. And so there's like, it's like they learn stuff without like a first principles approach. And what that means is at the time, they don't think anything of it. And then like 5 years later, 10 years later, 20 years later, it bites them in the ass because, sorry for cursing, it bites them in the butt because they don't even realize that they don't know very fundamental things about what they're doing. So that's how I got started. And it kind of went from there.
That's interesting. So I'm assuming that was a great advantage to you. I mean, I don't think a lot of people who know the bankruptcy code are actual investors.
I should. Well, no, there are some. Now they're very like legal eagle like investors, like guys who really know bankruptcy, and those are the only people I'd ever give money to, by the way. The distressed guys who try to be sort of magpies and they've been around for a long time, I don't have a problem with them. But my favorite type of investor in the sort of distress space are the guys that really, really know the restructuring process inside and out. Or, I've met guys who do litigation funding, international arbitration stuff. And these guys are just smart. And I wouldn't say that they always get it right, but your job as an investor isn't to always get it right. Your job as an investor is to sort of underwrite risk and to, on the whole, make money. And even Howard Marks, who's like, one of those people that, myself, I idolize, says, your job is not to lose money. Your job is on the whole to make money. And if you're not losing money, you're not taking enough risk. And he's totally right. That's just me. And I got lucky that my parents knew a lot about it. And who knows what I would have done. I would be investing capital, whether I was good at it or not, because I love it. And that's also part of it, which is you meet a lot of people who are just trying to make money. They want to have a good lifestyle and they figure, oh, if I go into finance, I will make good money because people in finance make good money. And that's fine, but there'll be a passion missing, I think, from what you're doing. And I think distressed at its core, or opportunistic special situation and distressed, is sort of like the ultimate bounds of creativity. You're always learning something new about something you know nothing about. You're learning about Italian government receivables or Cuban confiscation bonds and Cuban confiscation law, or you're learning about offshore oil rigs that you know nothing about. So it's boundless amounts of new things to learn about. So
I heard the story about one company that had claims against Russian bonds, like old Russian bonds, and for some reason the Russian government decided to pay them.
really?
I think it was just a nationalistic movement from Putin to pay old bonds. So weird stuff happens in these markets. So you might get lucky on those Cuban bonds. Yeah.
No, I don't own any, just for legal reasons. I do not own any of these Cuban bonds. I'm not allowed to. I'm an American, so we're not allowed to touch those bonds. But they are out there. They're probably interesting. Same with Venezuelan bonds. I mean, for me, I have this theory I was talking with someone recently about it because we're talking about distress. And I was saying, you know what? There's nothing intrinsically good or nasty about any given activity. It's just how you actually handle yourself when you're doing it. And what I mean by that is, like, the largest trade I've ever done was buying individual claims from people in a bankrupt cryptocurrency exchange. And there's a nice way to do that, and there's a nasty way to do that. You could treat people with respect and try to have, some, I'm not sure what the phrase would be, but just sort of respect for the fact these are individuals. They've been screwed by this exchange that's gone under, and you're trying your best to say, look, this is what the workout value is going to be. I'm not messing with you. I have to buy it at a discount because this is a business. If you want to sell it, I'm here. I'm the highest price, or maybe there's someone with a better price. I think I can offer you just as good service, better service than them, faster closing, faster payment, no jerking around. We have a good reputation. But if not, you should just hold it. And there's something to be said for the way you go about your business that has nothing to do with the underlying of what you're doing. And I think that's true in distress, because you run across, and we were working on a deal recently with a third generation family business in New York City. They own a building, and that's really the only asset they have. And the way you go about working with them to give them capital to maybe get through COVID, I think makes a difference. I think it makes a difference how you do it. And I think it's true in distress. But no, in the Russians and with, sovereign insolvencies, that's a whole nother conversation. I'm not an expert on sovereign insolvency. And I would say that it's not for the faint-hearted, because it could take a long, long time. And even then, it's like you have to be realistic, on what your recoveries could be. So
yeah, those sovereign bonds they're basically lottery tickets, right? So the risk is extremely high.
It's high.
Yeah.
It's high. I don't know if all of them are lottery tickets, but even something like Lebanon, I was talking with someone recently, or two different people about Lebanon recently, and their view is like, well, it's the last bond that has New York law. And, even though Lebanon doesn't have the money to pay those bonds back, there's no way that the Lebanese can go back to the international finance markets without paying these bonds, because the moment they touch international soil, these bonds can attach to whatever they've done. And I'm like, okay, that's kind of cool. And so their view is that there'll be a political, like, sort of remedy. So you're sort of leaving the page of what's, securities analysis when you start talking about sovereign bonds, which is, sovereigns, countries can write their own rules. They can decide to do whatever. If they have oil, then they can do something with it. The leaders maybe have different ideological viewpoints about who between who owns the debt, and so it just sort of leaves the page of doing securities analysis. And I'm not saying you can't do it, but as someone like myself who's a bit more schooled in doing securities analysis and idolizing Warren Buffett, it's very, very difficult to do the analysis, because you're like, I have no idea what the government of some country is thinking. I don't know what Raul Castro is thinking. I have no idea what the guys in power in the Lebanese government are thinking. So you're really leaving the page of doing securities analysis, and it's really like a game of chess. You can do it, but it's just not securities analysis.
I heard you once talking about your story with fund.com.
Oh yeah.
Yeah, so could you tell us more about it? How did it start off? And how did you end up with it?
It's sort of like, let's see. So it was a penny stock. It wasn't a penny stock lovingly, but it's basically a Left 4 Dead stock. And I don't know. There wasn't much to it. There was a guy that had been running it that was likely a fraudster. I gotta close the door again because someone closed the door again. But there had a smattering of assets in it that were real, but the guy running it was a total fraudster. And I came across it just as anybody would, any stock like that, just as like a penny stock, and that was supposed to be like a net. I think it might have been on a net screen. And as I researched it, I was like, there's not much. There's actually nothing left here. And I started buying up stock, just thinking like, oh, maybe I can do something here. Maybe I can. Who knows? Who knows what can happen? There's like a smattering of assets that could be worth like multiples of the market cap. So I just bought up stock very, very cheaply and just sort of sat on it and didn't think anything of it. And then like rumblings like online about maybe what it's worth and whatever. And then the guy that was running it got indicted, got criminally indicted in a different matter. And the long story short is he went behind bars. So I decided to petition the court to become basically the trustee / liquidator of the company. And we went through, and that's kind of the story. And so I've been basically liquidating assets and prosecuting any assets I can find and trying my best to get the best recovery. So, I mean, it's going to work out fine in the end. I wouldn't say it's the best investment I've ever made. It's been years and years and years of work. But yeah, so that's kind of the story. And I would say some things have worked out better than others. That one worked out fine, but it was not like a home run because it's taken up so much of my time over the years. Because the gentleman that ran it really was a criminal. I mean, he is still behind bars, but yeah, but those kind of things, I don't work on those too often, but they are out there if someone wants to try to find these kind of opportunities. And I don't dissuade people from looking for them. I mean, we're talking about Cuba. There's 2 companies that have Cuba confiscation claims that are publicly traded, and they trade for peanuts compared to their confiscation claims that they actually have. But Cuba confiscation claims, the Cuban government technically what's the phrase, they acknowledge their existence and they think that they're valid, but of course they're not paying them, and it can take many years to get paid. I would say that it's kind of fun to buy a little bit of that stuff on the fringe, but every now and then I just feel the need to like really back off from that stuff and say like, hey, just understand, like this needs to be a tiny piece of your portfolio. Because I find that every now and then someone will call me and be like, dude, what's going on, man? I have like my down payment for my house and this thing. And I'm like, what? I'm like, dude, this is like the riskiest thing you could buy. He's like, oh man, I think this is great. We're gonna make like 20 times our money. And I'm like, so you just need to stay away from that. And it happens because we don't have a lot of money. I get it. Like the inclination is to just like bet the farm because you think, oh, whatever, it's $10,000. Like I'll make this. I'll work if I need to, but like this would change my life if I made 10 times my money or 25 times my money. So I just be careful of this sort of mentality that sometimes it sort of happens with people when they sort of think like, it doesn't matter if I lose it, but if I make 20 times my money, I could buy a house. That's dangerous because it makes you, what I'm saying is it makes you want to believe in a story, and that is affecting your judgment and it's coloring your judgment in a bad way.
Yes, sizing is very important in these things.
Exactly.
So over your time in investing in these stressed investments, what was your biggest win? How much as a percentage did you make? I want to know, like, what are the possibilities of making a huge amount of money?
I don't know. It depends on like dollar for dollar. Like Mt. Gox is the best thing I've ever done. But if you do percentage terms and IRR, like multiples my money, I made 60 times my money in 6 months on one thing. And then another thing, the Mt. Gox thing, okay, I made 40 to 50 times, well, more than that, but saw 50 times my money, but it took a few years. And also there's more money at risk. So like it was real money at risk. I mean, the other one, I didn't have that much money at risk, but that's why I figured like, oh, I only have like 30 grand, like a 30 and the 30 turned to 300 and 30. So I sort of rolled the risk. So both, yeah, I've had some other things work out like that and some I've missed. I mean, one of the things I don't think people appreciate, I love reading biographies of businessmen throughout history. Whether it's like, I don't know, someone like Paul Getty, who's like a famous oilman, and like, I don't know, you name it. Like I love reading autobiographies of famous, I guess businessmen and women. But I think the reason is because I almost want to get inside their head and think about how they're thinking about risk. Because I don't know, I just sort of think that so much of like when you read people that are investors, like that are managing hedge fund money or mutual fund money, or I don't know, Terry Smith is a famous guy here in the UK. It's sort of like they're telling you how to invest if you want to invest other people's money, and that's fine. But like, what if I don't have other people's money? It's kind of my money, and maybe it's people that are really close to me. How do I like make the most? How do I like really bet big and like win big if it works? And I kind of think that the guys, if you think about like, a hedge fund has like a diversified hedge fund has 300 positions. A concentrated hedge fund maybe has 30. An ultra concentrated hedge fund maybe has 5 to 10 positions. Like think of like an entrepreneur or a businessman. What does he got? He's got one position. That guy knows about risk, And so I really like studying guys who have taken on a huge risk. And sometimes it hasn't worked out. Sometimes there's a very famous book by this guy named Bill Zeckendorf, and he's like, there's this guy who famously made huge amounts of money and then went totally to zero. And I just enjoy reading him. I think there's something interesting about that. So for myself, I love reading that. And the best one, I guess, I don't know, if you had to choose, I don't know, probably Mt. Gox is the best one ever happened to me. Because it's the most amount of money made, like dollars, like how, so, and those, they don't come, well, I guess my point of bringing in the biography thing is they only happen every couple of years, so like I'm on Twitter and guys are like, I'll get people who DM me and some people are super nice and they're like, oh man, thanks for sharing everything. It's great to connect. And some people are like, dude, what's going on? Like, what are you buying right now? Like, what's your favorite like 10xer? And I'm like, I don't know. Like, I don't know. Like, I most of the time, I don't know. I don't have anything that's that great. And every couple of years, I will put a lot of money on something. And, for the most part, the ones that I put a lot of money on have worked. I don't know. Maybe it's roll the dice. I don't think so. I think for the most part is I'm waiting for something that's a really, really fat pitch. And the other times in between, I might be betting kind of around the edges, but I'm never like totally pounding the table, putting a lot of capital at risk where it can, just absolutely impale me if I'm wrong. But that's not, I guess what I'm trying to get across is when you read some of these investment books, just to remember what they're trying to do. Most of them are trying to convince you to invest with them, but they want you to believe in their approach. Most of them at the second layer are trying to teach you how to optimize for capital pools that you don't have. When you read David Swenson, who I love, he's a famous Yale endowment manager. He's trying to run $18 billion. I don't have $18 billion. And so my optimal strategy is going to be different than Yale endowments. And even Warren Buffett. Warren Buffett is amazing. But Warren Buffett has 100 billion, I don't even know, $200 billion. So his optimal strategy is much different than your eyes. He has a much different time scale. He's in his 80s, right? you know, I don't know your age, but we're younger and we can take a bit more risk. We can get involved in things that are maybe more tech focused that, you know, Buffett just doesn't have the time, or he doesn't want to take the risk on, or even if he makes 100x on $100,000, that means nothing to Warren Buffett. And so I guess my point would be is like, what's good for them is not necessarily good for you, and vice versa. And so read those books, but just remember that what's optimal for you might not be optimal for someone else.
There is a reason that Howard Marks writes those memos, and it's to raise money.
Right, write me the checks, baby. Write me the checks. No, he's amazing. I have to say, he is absolutely amazing. I love so much of his work, but you just have to remember, like, he's running, I don't even know, $100 billion. Like, okay, you have to be very thematic, and you have to be in a lot of cases, a lot of dockets, a lot of situations that work. You have to think about your philosophy. If you have a few $1 million, or even a few 100,000, or even 10,000, the world's your oyster. You can do all kind of stuff. The one thing you really don't want to do is you don't want to go to zero. Going to zero is bad, because then you don't get to play anymore. They tell you to get up from the table. You know, you're like, sir, I'm sorry, but you can't play anymore. And so that's what you really have to watch out for. And, you know, you have to be really humble about it. I mean, a lot of guys on Twitter who are extremely good at what they do, but I find some guys are smart and they're humble. A lot of guys actually are not so humble. And I think that's a mistake. I mean, I was listening to a podcast recently and someone said, I don't want to be picking up teenies. What he said something like scraping teenies or picking up teenies. He means like little tiny, well, I'm going to make a little money here, make a little money there, make a little money here. That's not really the way I approach markets. I prefer to place fewer, bigger bets every now and then. And sometimes I'll be wrong, but as long as I don't get hurt too much on the ones that I'm wrong about, and I really hit the ones that I get a hold of out of the park, I'll do just fine. You know.
So could you just tell us the story about the one that made you the most dollar amount? What was your thinking before that? Was your rational forecast correct? How did it work out for you?
Yeah, so I mean, I have to look and look what's the price of Bitcoin right now, but I would say in about 2015, 16, I had run across an article in the FT about this thing called Bamkank, which was a large cryptocurrency insolvency that was going on in Japan. And, you know, my parents were bankruptcy lawyers. I knew a lot about buying claims because I've been buying claims in just regular bankruptcies. And I was like, hang on a second. You're telling me that I can buy Bitcoin, but instead of paying full price, I could pay for a fifth of the market price. I was like, well, that's interesting. I like half price. I sure as heck like 1/5 of the price. So I bought a little bit of claims and I sort of sat on them. And I always tell a friend, oh yeah, story, you know, you can buy Bitcoin at 1/5 the price. I'll buy you Bitcoin for half price. I'll buy you Bitcoin for cheap. And some of my friends were like, oh, that's really interesting. Other people were like, what? This is risky. Bitcoin worth zero. And then fast forward to about 2018, the trustee, this is a Japanese insolvency, sold a bunch of Bitcoin into bankruptcy. And he sold about 1/5 of the bankruptcy, and that raised about 600 or 700 million US dollars, about 650-ish. And so you could buy claims in the bankruptcy below the cash value, right? When I say cash, I mean like the fiat US dollar value. And yet you were getting, and so here was the cash value, 650, and I could buy them here at like 400, 450, 500. So I was getting all this extra cash, and I was getting Bitcoin for free. And yeah, exactly. Wow. And so I was like, this is the best trade I've ever seen. If I can get my money back and I get a free option on Bitcoin, like the most volatile asset I've ever heard of, ever seen. And remember, Bitcoin at the time, this is 2018, so Bitcoin was like, it was like 10,000, but I mean, it ramped to 20, but it went to 20 real quick and it came back down. And I was like, I don't know much about Bitcoin, but if this works, this is gonna be huge. And I was like, you know, if you look at option pricing theory, the big determinant of what an option's worth isn't even the price so much as the volatility and the duration. So I was like, this case could take 5 years, which, you know, what is it? 2018 is 2021 going into 22. So we're getting there. We're getting to 5 years, and it's the most volatile asset I've ever seen, and I get it for free. And so I put all my money into it. I put every single dime of excess capital I had, other than putting food in my kid's mouth, and it worked. It worked. And I got a family office to put some money into, and they now will probably buy themselves a very large yacht. And I always tell them, you can name it after me. And his response is, I'll name the dinghy after you, Thomas. And I said, oh, okay, thank you. But it's, at the time, the risk reward was so good. I was like, it's really hard to lose money. And if it works, ooh, it could really work. And that was always the thesis. And you weren't sure exactly how it was going to play out, but you knew the risk score was really strongly in your favor. And so that's kind of what I'm always looking for. It's just, you can't, it's something like people say like, oh, I make investments. You don't make anything. Like, investments are just out there, and then you have to be out there and kind of fishing around. It's like a fish. You don't make a fish, you catch a fish. Like, these investments, you just find them out there because you're out there trolling around, looking all day and all night for years. And then one day you find something amazing. You're like, this thing's amazing. I should put this on a scale. And then you, of course, convincing other people of your ideas is hard, but you try to. And that was the one. And that worked out pretty well. So, I mean, without going into too much details on numbers, because I know my investor probably wouldn't want me to, but yeah, over 40, probably over 50. I mean, myself with the promotes, it's way over that. But for them, just like the raw return from the investor and my own investments, yeah, probably over 40 or 50. Yeah. Times our money with real amount. Yeah, with real money.
That's amazing. And, this is something I always think about.
I'll never be able to recreate it. I'm done. Why do I have me on your program? I'm like the old horse. You take him out back. I'm not good for anything. It'll turn me into glue. I'm not good for anything.
Sometimes just opportunities hit you on the head. You have to be kind of greedy. You just don't go for the low return to the risk.
I think that there's something to be said for that a little bit. I don't know if it's about being greedy. It's kind of like, this is probably the only one I'm going to get. So I have to kind of like go for this. And be like, even for yourself, like, I don't know if you're interested in startups or even your podcast, you think like, holy moly, like, I'm really good at this podcasting thing, or I'm getting good at it. And I have like this whole suite of like family offices. I don't know for yourself, from the Middle East, it's like one access and stuff. And I'm kind of the only one doing it. I should probably just do this. And I think so, there's something about like, opportunities will happen throughout your life, but you have to grab them at the same time. Like, I meet a lot of people who are like, oh, I once had this thing, but then I was like too scared. I'm like, okay, like, I don't know. You want to feel bad for you? You stay to your cushy job, like, so I just think that it doesn't bother me, but you're only going to get so many opportunities. But you have to, for me, in the investment world or distress world, you have to be fishing, and then you have to jump at them when they come. You can't just like passively be like, oh, maybe. You have to have a little bit of courage of conviction. And that's when I was younger. The thing that held me back probably the most is my parents were very, very middle class. And I was basically told to not ask questions. Everything was figured out for you. Like, you just go and you do your work. You do an honest day's work. You don't try to be an opportunist. And it took me years to kind of unlearn that a bit, because that'd been kind of inculcated in me. Like, don't ask too many questions. Don't be too loud. Mind your own business. Like, and I probably sound brash on this podcast, but you do need to be a little, when you see something, a bit more assertive about how you approach it.
So, this company was in Japan, right? The bankruptcy. So
Yeah.
Have you had much experience outside of the US?
No.
That's the only business.
Yeah. So, I mean, at this point now we've done, I have to take out one of my headsets because one of them's dying. So I had not had much experience out of the States. I had to learn about the Japanese insolvency system. It wasn't that hard. But it wasn't easy. And this is the other thing about it. It's like, you have to be willing to kind of self-explore a bit. So the first claims I bought and the first claim I bought, I really didn't know what I was doing. I mean, there's no way to beat around it. I knew enough. I was like, oh, okay, I found the seller. He wants to sell. I have a contract. I don't know how to actually do the transfer, but maybe we can figure this out. And I remember I told the guy straight up, I said, look, I'd love to buy your claim. I think this is super interesting. I know you want to sell it. I actually don't know how to do the transfer. I remember on the phone, I was like, I actually don't know how to do the transfer. You are going to be the first. And he said to me, oh, okay, man, no worries. This guy worked at Google. He was an early Bitcoiner. So imagine where some of these people are from. Like, this guy was still working at Google. He had the Google attorneys write the claim documents for the transfer process, and they actually figured out the claim process, and they helped me. And I was just like, wow. And then the lady who had escrow set up with his law firm, it was like, he was working at Google, but he also had a startup that he had started. Somehow Google allowed him to do this. And I remember it was such a funny experience, because I was kind of honest with the guy. I said, look, I'm not sure how to do the transfer, but we sign a document. I'll, of course, email the people in Japan, and we'll start the process, and I'll do my best to figure it out. But his attorney was amazing, and she figured it all out. I didn't even have to do anything. No, I mean, we did have to do a little something, but she really did help a lot. And so I learned about this process as we were going about it. And I think there's something to be said for that, which is keeping an open eye for exploration, like not always just being like, oh, well, this is what I know about, so I shouldn't really go over here. There's a delicate balance, I suppose, in every business between, someone said this once, they said there's a delicate balance in business between exploration and exploitation. Sometimes you want to be exploring, and sometimes you want to be exploiting. You're sort of like your competencies. Like, these are our core competencies we're exploiting, and this is where we want to explore the new territories we know anything about. That was that for me. Yeah.
Yeah. So we want to head to the last question.
Sure.
What would you recommend to someone getting into this industry? Distressed investing in general, and bankruptcies specifically.
I always say, if you really want to learn about it, just go and do it. You know, don't read any more books. Like, read the books, but the books are just nothing. The books are like, of course you got to read the books. It's like, I've already got to read the books. But if you're gonna like find something interesting, you know, you sort of need to be traipsing areas where you're leaving the page. And it's not just about like route memorization of something that's in a book. And you have to really read a lot. If you're interested in it, just go and do it. And the experience is really, and if you can find, this is one thing I never do this, but I would tell people, if you can go and learn from someone like the foot of a master, that's how you will really learn something. You want to learn something, go and work for a guy that knows how to make an awesome cabinet. You will learn how to make some awesome cabinets. And I think there's something to be said for apprenticeship. And, you know, back in the day when you used to learn the law, I'm sure this is true in other countries still to this day, but in the States, you used to go apprentice to become a lawyer. You didn't go into law school. Like, how would you even learn anything? You're just like reading from a book. It's all dry. You don't even know what's going on. Like, these are old cases. No, you would go and apprentice for a lawyer for I don't even know how long. And then over time, they would say, okay, I would say, okay, he knows enough. He can now take the bar. He can sit for the bar. And I think there's something to be said for that in distressed investing, like, or any type of investing. You're probably better off find the best investor you know and ask them if you can come work for them. So that's one strategy. Go work for a really strong mentor or someone you think is amazing. That's one. You can go and do it on your own and be very autodidactic about it, where you'll just learn on your own. It's a harder road. I think you'll learn it better, and I think you'll be less dogmatic. Like, you won't. I meet people that work for amazing mentors, but then when they're on their own, they have a little bit of a hang up, which is they really know well what their mentor taught them. but they're not free yet from the dogma that their mentor gave them. So I see that as a hang up in some people, even in distress. And you know, go out there and do it. I mean, it's sort of it's something you have to do because you love it. I think if you're just doing it for money, there are lots of ways to make money in the world. You can work in consulting, you can go and work in the government, you can go and work. There are just so many ways to make money, and it doesn't have to do with in like taking risk as an investor. If you don't love the idea of learning about businesses and then underwriting risk, you know, and for myself, it's more legally driven. So it's like, you know, learning about new areas of the law that you don't know a lot about, and then underwriting risk based on that. Forget about it. Go do something else. Do something you love. Don't just do this for the money. There's so many other ways that you can make good money, and it doesn't have to be, you know, in like running a hedge fund or working in distress. Which I just meet a lot of guys who do that. And I just think like the problem is after a few years they get bored and they stop learning. If they stop learning, stop growing, you stop growing. It's just you're never going to become a true master at it. So.
Yeah, that's great. Continuous learning is really important in this business.
Very important, in my space at least.
Thank you, everyone, for listening to this podcast. I hope you enjoyed it. If you enjoyed it, you should share it with someone you think would find this interesting. Thank you, Thomas, for joining us. Have a nice day.
Thanks for having me.
Yeah.